Okay. So last time we looked at weighted average cost of capital, and for the weighted average cost of capital, you need to calculate CAPM. For CAPM, you need to calculate beta. For beta, you need to calculate returns, and for returns, you need to use the formula final minus initial divided by initial. So on day one, if your stock is valued at 200 rupees, on day two, means 2nd of June, if the stock is valued at 210 rupees, then use the formula final, that is 210, minus initial, that is 200, divided by initial. So final minus initial divided by initial, and there you have it. You get 5% returns. So you copy the same formula, extend it right down for the next 6 months, and there you have your returns for 6 months. I believe I have answered your question.
Yes, sir.
Okay. Anybody has any other questions from the last session? Any doubts? Okay, so today what we're going to do is we're going to do valuation of long-term securities. You already see this uh, on your screen. Now, when I say long-term securities, we mostly will be looking at bonds. Like it can be a 5-year bond, a 10-year bond, a 1-year bond, and let us understand what we are talking about. What are these bonds? What does the tenure mean? What are the terminologies involved in bond transactions? So today's session is primarily going to be about this. So we'll look at bond valuation, preferred stock valuation. Although it is there part over here, I'm not going to take look at it much. We look at common stock valuation, rates of returns and yields. We will look at what is called as liquidation value. Okay, so liquidation, any time in accounts or in finance, when you look at liquidation, it means that you are disposing a particular asset, and you want to get some returns from it. So suppose you have a bond, you may have this thing. Just a second. No? If you have a bond, you may want to sell that bond and get some money out of it. A bond is like a long-term debt security as such. We'll see a little more about it as in liquidation. There are two types. There are actually three types of the way you can liquidate an asset. One is a going concern value. Like suppose you have a company, suppose you have a car, okay, and the car is in a perfectly working condition. You want to dispose the car because you want to get a bigger car because your family has grown. So you will sell the car uh, at a particular price, and this price will be the fair market value of the vehicle. And such a fair market value of the vehicle will be called as a going concern value. Means going concern means the car can continue to operate. The car is in perfectly working condition. It's just that the owner has been changed. No doubt the car is a little old since you bought it a year or a few months back. Then there's something which is called as residual value. Residual value means you have completely used up the asset. There is no function left in the asset as such. So it is not going to give you any functionality. And when you sell such kind of an asset, it normally goes as a residual asset. And you get a much lower price for a vehicle like this. In terms of the car example, it will be, suppose you had a very old car, a 15-year-old car, a Maruti car, not a vintage car, okay, an old regular car like a Fiat Padmini or a Maruti or an Esteem or an Omni, and it's giving you a lot of maintenance problems. It's not operating well. It breaks down very often. When you sell when you liquidate such an asset, you will get the residual value. Like when you go take it to a person and say, I'm not interested in buying it. No other buyer will buy it. You'll have to sell it to the kabadi walas or to the scrap people, and they will give you the value of the vehicle, not as a going concern, but as residual, as something which is scrap. So this is how valuation is done. When we look at in stocks in companies, we always look at what is the assets of the firm, what are the liabilities of the firm as such, and that is how we did a very basic book value assessment when we did the first exercise for company valuation. We looked at what was the equity, and from the equity we no, that was for market value. We looked at the assets what were there in the balance sheet. We looked at the slight profitability of what is there. We looked at liabilities what was there, and from that we tried to get a fair assessment of what should be the book value of the firm. Market value we already did. It is equity multiplied by the current share price. Unfortunately, this can only be done for companies that are listed in the public domain. So something that is listed on the stock market, then you can do it. Otherwise, difficult. Okay, so now let's get down to the core of our topic, that is bond valuation. We are going to look at important terms. We're going to look at different types of bonds. There are with coupons, there are without coupons, there are semi-annual coupons. There is, how do you evaluate all of these things is what we're going to study. Okay, so coming to bond, okay, a bond is a long-term debt instrument issued by a corporation or a government. So what the RBI does is, on behalf of the government, whenever the government requires money, so the RBI will issue these bonds. Okay, they're called treasury bonds. They will issue them, and various banks, various high net individuals, corporations can buy these bonds. So the way it works is, they will have a bond which is say 100 rupees in value, and they will auction it. They will auction these bonds to the bankers who want to invest in this. And the way they auction is they will say this particular bond will give you a 10%, not 10 is too high. Now they'll offer something around say 5% interest every year. So if you buy the 100 rupee bond, you are going to, the 100 is the face value, you will get say 5% interest every year. And they are going to ask the banks, how much money will you give me for this bond? Okay, how much money will you give me for this bond? And then everyone auctions, and whoever pays the highest amount of money for this, that person will get that particular bond. So it's an auction system that happens as such. In a bond, you have a couple of terms which we will see. The first is called as the maturity value. Now, this is the face value of the bond. So means at the date of maturity, when you go to redeem this bond, okay, initially you have to buy the bond. It's like buying an LIC, what do you call, an LIC policy.
Policy.
You can, yeah, thank you, dear. It's like buying an LIC policy, where you put in, they have promised you that on the date of maturity, 20 years from now or 10 years from now, I am going to pay you 100 rupees. That is the value. And for that 100 rupees, you have to pay some small amounts today. Okay. Now, unlike an LIC where you have to pay premiums every year, usually when you buy a bond, you have to pay a premium once. So you just pay a premium once. That money is used by the RBI and by the government for infrastructure development. Okay, so what the government does is, whenever the government needs loads amount of money, suppose they need to build a bullet train from Mumbai to Ahmedabad, and they need around 1 lakh crore for it. So what they'll do is, they will go out to RBI, say we need so much money, please arrange for it. RBI will go to the banks and say we need 1 lakh crore. I will give you bonds worth 1.2 lakh crore, and all the banks will bid for it. They will give them the 1 lakh crore, and 5 years from now or 3 years from now, or depending on what the maturity value and what is the term of the period, the government will return back this money after they start the railway project, after they make money, and then they have money to return back to the bankers and to the people who invested. So it is nothing but like a source of gathering money. A bond, an institute which gives out bonds wants to collect money for some project that they have in mind, and the investors are usually these high net corporations, individuals, banks, which can go and apply for bonds. They can invest their money in the bonds. They know it is going to be secured because the government of India usually issues these bonds. It's issued by RBI on behalf of the government, and they get a good return at the end of it. So this is what is called as a bond. Does anyone have any queries, any doubts, questions you would like me to ask? You would like me to answer? Anyone?
No, sir.
No, sir.
Okay. Now let us look at the next thing. Okay. Now
So,
some of these bonds, yeah, yeah, yeah.
so bond is issued only by governments or other private companies can also issue it?
Companies can also issue it, but they are called as commercial paper. They have different names for it. Normally, when we call as such, we normally refer to these government treasury bills or government bonds which come up as such. It can be a 1 year bond, 6 month, 3 year, 5 years, 10 years. It's usually what the government issues. And a lot of the money which banks have to, if you look at your SLR, statutory liquidity ratio, a lot of those investments have to happen in these bond markets itself, the government bonds which are issued. So uh, there are cases where companies issue it, but because a company can always go bankrupt, okay, a company can, when a company issues a bond, it's like, you will ask a question, why doesn't the company go to the stock market and file an IPO and take money from the market? Or why doesn't the company go to a bank and take a loan from the bank? So these are the questions which an average person will ask. So usually commercial bonds are not so popular, but yes, large companies like Tata's, like the Leylands and all these companies, they do issue bonds also, but they're not very popular. Now, Ria, I hope I've answered.
Yes, sir.
Okay. So now in a bond, okay, when you invest in a bond, sometimes some bonds are coupon bonds. So every year, like how you have dividends which come when you have a equity stock, when you have a bond, there is sometimes an amount which is given to you every year. Now that money which is given to you every year, like a dividend, is called a coupon. Okay. So if you have a stock, the return that you get is called a dividend. If you have a bond, the return that you get is called it's called
Coupon.
what? A
Right.
coupon. Perfect. Okay. So now there are some bonds which don't have any coupons. All the coupon, the whatever money has to be given out as a coupon is given out at the end of the period. So if it's a 5-year period, 5-year bond, you get only the money which comes out at the end. So it's just a matter of what kind of bond is being issued. Some give regular coupons, some don't give coupons. There are various factors like that. Okay. Then the next thing that we see over here is the discount rate. So the discount rate says, like suppose a company, like suppose the government of India, I'll take the previous example, they want 1 lakh crore to build the bullet train from Bombay to Ahmedabad. Okay. Now if they want 1 lakh crore today, and they tell the people, okay, I need money today, please invest in us, I will give you the money back after 10 years. Okay, suppose this is what they say. If the government says, I will give you back your exact how much money you gave me, I will give the same amount back to you. Do you think people will be happy about this? That if I give 1 lakh crore now, I will get 1 lakh crore after 10 years. Do you think the people are going to be happy?
No, sir.
They're not going to happy and they will not invest in this.
Yes. Now, for them to invest, how will you have to convince the people? What do they need in return for them to accept that offer from the government? Do I have to pay more money after 10 years or less money after 10 years?
More money after 10
More money,
years.
sir.
Yes. So now how much more money to pay? How much more money to pay? That is the question.
By using present value formula, we can calculate it.
Okay. So what an investor will do is he will use the future value. He will say, I am paying 1 lakh crore today. I'm paying 1 lakh crore today. I will require 1 lakh crore into 1 plus r raised to n. Okay, 1 lakh crore. What's the future value is equal to present value into 1 plus r raised to n. Remember, right?
Yes, sir.
Yes, sir.
Okay, so he's going to calculate my interest rate. If I were to put it in a bank, how much money I would get? I would get around say 6% or 7%. So he is going to, but he will say, if I put in mutual funds for 10 years, I may get around 10 to 12%. If I put in the stock markets, I can get up to 13%. So he's also caught in a fix what number to take. So they take a figure which is not as high as the mutual funds, but not as low as the stock markets, not as low as the fixed deposit, because they know this money is almost risk free. It is risk free. If I give it to the bank, it is a risk free amount, but I get low rate of interest. So let me get a little higher than that. So they will say, okay, let us expect 7% rate of interest. So these investors will assume a 7% rate of interest, R as 7%. The number of years the government said, I'll give it after 10 years. So you put it as 10. They make the calculation. Whatever comes as the value, is the money that these people are going to expect to be as the maturity value. Is this part clear to everyone?
Yes, sir.
Yes, sir.
So what they do is, in their mind, they will make the calculation. The government needs 1 lakh crore today. Government will give me back the money after 10 years. Government, I need some rate of return. So let us use future value. How much should be my future value at that time? So they will do that. Okay, future value is so much, present value is so much into 1 plus r is to 10. I get an answer. They'll say how much rate of return I must consider. They'll say, okay, let's consider 7% rate of return. They do the calculation, they get a value, and that is going to be their maturity value. Now, what they usually do is do the reverse. The government does not tell how much money we want now. Okay, the reverse happens practically. The government will say, after 10 years, I am going to pay you I'm going to pay you 2.5 lakh crore. Okay, so government will say, I'm going to pay you 2.5 lakh crore. How much money are you willing to give me today? You got it?
Yes.
So, although it makes more sense the way I explained the first part, where the government should ask how much they want and then calculate future value, what actually happens in real life is the future value is presented, and based on that, they will ask you to bid for the present value. So that is why, since you know the future value as 2.5 crore, you will back calculate and you will figure out for that R what interest rate for 7% and n what should be my present value. So in effect, what you're doing is you're calculating the present value, how much money I'm willing to give today. And that is why that R is called as the discount rate. Is that clear?
Yes, sir.
Okay, so it's just like instead of eating straight, you got to eat all the way around. You got to put your hand all the way around and eat like this. So shit happens in finance, but you can't help it. So if coupon rate is clear to everyone, discount rate is clear to everyone, can I move on to the next slide, please? Can I?
Yes, sir.
Okay. So now we're going on to the next part, which is called, now what we've learned now is what is a bond. We have tried to understand what are the various terminologies in the bond. And now we are going to witness how an actual bond is calculated. Okay. So the very first type of bond that we have is what is called as a perpetual bond. Okay. So a perpetual bond is, at times, it's like almost like equity. A perpetual bond is almost like equity. It is there are some organizations which have issued perpetual bonds. So they will say, my bond, my bond will, the moment you buy my bond, okay, forever, for an entire life, as long as the company remains, you will continue to get a coupon. Okay, you will continue to get a coupon which has the value of I. Okay, right now let's assume that coupon value is I. You will get that every year for the rest of your life. Okay, get a coupon value of I. In this case, in my example, it is I. It can be 100 rupees, it can be 5 rupees, 10 rupees, depending on what the company has decided. And this I will provide you for the rest of your life. Okay. So now the company will say, at what price are you willing to buy this bond of mine? At what price are you willing to buy this bond of mine? Okay. Have you all understood the question? Don't look at the screen right now. Don't look at the screen right now. Just try to understand what I'm trying to tell you. Okay. I want to sell you a scheme. Okay, look at this. I am selling you a scheme. In that scheme, I say, if you invest in me right now, if you put an X amount of money, I will give you I amount of money every year for the rest of your life and for the rest of the company's life. As long as the company is alive, it will continue to pay you an amount of I. Is my question clear to everyone?
Yes, sir.
Amount. I is the amount. Okay. So now you have to figure out what is the value of I. Suppose my coupon I is 100 rupees. You know what? Let me just change this damn thing. You know, when it's I, it's confusing for bloody everyone. I too get confused. So let me first change this. Okay, I think you can see this change happening in real time.
Yes,
Yes,
sir.
sir.
Okay, so I'm giving you this coupon, and I want you guys to figure out what should be my the value of this particular scheme that I'm giving you. Suppose I say every year, okay, every year on the 1st of January, I am going to, or let's say every year on the 31st of December, I am going to give you 100 rupees. Okay, every year on the 1st of December, I am going to give you 100 rupees. What should be the value of my scheme? How much money will you give me to participate in this scheme? Does anyone have any idea how to calculate it? It's quite easy actually. The answers on your, you remember, so what we can do is, can anyone at least think of the approach? What kind of approach should I have to solve a problem like this?
So basically, that formula will only be used, that is that PV and FV wala. Only the thing is there will be minor changes.
Okay, see, the first thing you need to understand is, let us look at this in terms of cash flow. Okay, when I look at in terms of cash flow, I know that on the 31st of after 1 year, means on the 31st of December, how much money am I getting? On the first year, at the end of the first year, how much money
100
will I get?
rupees.
100 rupees. Okay, at the end of the second year, how much money do I get?
100.
100
100.
rupees.
Okay, yeah, so why are you all taking so long to answer? Just like unmute and say 100, 100, 100, 100. And third year, how much money do you get?
100.
100.
Fourth.
100.
100.
100.
Okay, on the 100th year,
100.
100.
100.
perfect. Okay, so now you all understand there is 100 coming every year. Now at the end of this money, which end of the year when I get 100 on the very first year, is the 100 equal to 100 rupees today?
No.
No.
How much is it worth?
Of course, less than
How
the
much
other.
less? How much less? Honest. How much is it worth? What is the present value of 100 rupees which I get 1 year from now?
Kevin,
Can see it's
direct
as
my
simple
sound.
as that. Come back, Kevin. Can you see that 100 rupees is worth this particular figure? Yes or no?
Yes.
Okay, so the 100 rupees which I get 1 year from now, I have to bring it back to present value, because 100 rupees is a future money. I need to bring that future money to the present. When I have to bring future to the present, I must divide it by 1 plus r raised to n. And you can see over here we've written KD. KD is nothing but R. Okay, so don't get confused. KD is nothing but R. So it is 1 plus R raised to 1. With that, I will get my present value. Yes or no?
Yes.
Yes, sir.
Now comes the question: what should be my R equal to? How much should my R be? How much would you consider? Suppose this was issued by this bond, perpetual bond was given by the government of India. How much will you consider the R to be? Will it be like 6%? Will it be 10,
So
12%?
6%.
So
Sorry?
7%.
5%.
Yeah. Yeah, okay, so it is fair enough. If you say 7, I'll accept it. You say 4, 5, I will accept it. If you say 15%, will I accept it?
No,
No,
sir.
sir. No, sir. It is
Why?
too high.
Why won't I?
Because the
Government
government
is
will
not
never give
giving
you
that
the
rate of
50% of
interest,
the
so
amount.
government can do this.
Because the government has low risk. When there is low risk, I cannot expect very high return. Correct?
Yes, sir.
Okay. So now we've seen the first year. In the second year, can you see this is the terminology for the second year?
Yes, sir.
100 divided by 1 plus r raised to 2. Okay. Then for the nth number of year, I get this thing like for infinity. Means at the time of infinity, the money which I'll get will again be 100 rupees. That I'll have to discount by 1 plus r raised to infinity. Now I don't know if you guys have studied series, time series in mathematics when you were in the 11th and 12th. But if you have an
Yes.
infinite series with this concept, okay, 1 divided by 1 plus r, 1 divided by 1 plus r raised to 2, 1 divided by 1 plus r raised to 3, so on and so forth, all the way up to infinity, you can write it down in this expression. You can write it down in this expression. All right. Summation I is equal to 1 to infinity c divided by 1 plus r raised to t. Okay. And if you solve this, if you were to solve it mathematically, the answer that you will get, okay, the answer that you will get is going to be what is given at the bottom. V is equal to C divided by KD or R. So C divided by R. Clear?
Yes, sir.
Okay. So what we have done is we have taken a difficult concept like something like an infinite perpetual bond, and we have reduced it to something which everyone can understand. So how do you get this valuation for a perpetual bond? You just take the coupon and you divide it by the rate of interest that you expect. It's so easy. So suppose someone gives you 100, someone says I'll pay you 100 rupees per year. You have to do 100 divided by 7%. And what is 7%? So when you have to solve this, one second, where am I? You will write, for example, 100 divided by 7% can be written as 0.07. Am I right?
Yes, sir.
If I solve this, I get my valuation, coupon valuation. Can someone solve this very quickly and tell me what the answer will be?
1,426.57.
28.57, sir.
Yes,
100
yes, sir.
divided by 0.07 is equal to 1428. Okay.
228.57.
28.57.
Yes. So you see, I have found a method to evaluate a concept like this. If someone gives me 1,100 every year, this is the money that I can expect if it is of so if it is so risk free. If the risk increases, then the value that I expect will also change. Okay. Can you see all of this is dependent on only two variables? Sorry.
So I have a question that we
Yep.
didn't consider the number of years while calculating this perpetual bond calculation.
So that is what I'm saying. The figure which is just about it, summation t is equal to 1 to infinity. If you solve this mathematically, you will get this ratio that you see down. And if you want to try it out, you can actually try it out. What you can do is make 100 divided by 1, 7 raised to 1 plus 1 plus 7 raised to 2, so on and so forth. Start calculating. In fact, let me just do it for you right now. Okay. I won't go to infinity, of course, but at least I'll take you halfway there. Actually, not even halfway, much lower. So, but it will be a lovely exercise. You'll get to see mathematics in action. So what I'm going to do is I am going to a new screen. I hope you can see my screen now. Okay, you guys can see my
Yes, sir.
screen?
Yes, sir.
Yes, sir.
Yep. Okay, so my coupon C is how much? 100. My return or discount, that is R, is equal to 7%. Okay, and yours is perpetual. Can you see this is what I've given? So let us calculate value of bond today. That is my present value is how much? Is how much? Can you see this is the question? So let us solve. So I have my coupon, I have my R, and I have my present value, okay, and I have my year. So let me solve. It is coupon value is 100. Sorry, I'll just take it from here. R is this. Okay, and here let's take 1, 2, 3, 4. So I'll just put a formula here also. This plus this figure. Okay, and this formula I'm going to copy all the way down to how much Excel will allow it. What happened? Oh, sorry. Okay. What the hell? Why is this not?
So you will have to freeze that one now.
No, I want to add the numbers. So 1 plus 2, this should have been 3. Why it's not calculating? B9 plus 1 becomes 3. There it is. Okay. Yeah. So it's not an automatic calculation. That is the problem. So let me go to data. In data, I'll have to calculate. No, formulas. In formulas, calculation options. It's automatic. It should have happened automatic. No, okay, no problem. So let's calculate present value. Present value is equal to coupon into 1 plus 1 plus R raised to, can you see this is the formula?
Yes, sir.
Hey, what am I doing? It should be 1 divided by, not multiply, 1 divided by. Yeah. So 93. Okay. Now I'm going to copy this for all of infinity. Actually, not infinity, but at least somewhere there. Please, Eva, what are you doing? Okay. So it's a fairly large calculation. So mine is going to take a little time. But in the interest of science, we will do this. मुझे लैपटॉप हार्डवेयर कनेक्ट कर देता. You can see there's one small gray little bar at the bottom and it's getting filled up. So,
Yes, sir.
once it comes up fully, we shall have the answers to our problems. So I think we've done 60%. Please bear up. I hope it's not too much for you all. We've done around 70%. So your patience is highly valued. कृपया इंतजार कर लीजिए. Okay. Okay, we're close to 8. If you have a laptop with you, you can repeat the same exercise at your place also, and ideally you should see the same results. Okay, 90% done. We're right there. Okay, 95% done.
भाई काउंटडाउन चालू कर दो.
6. क्या? अच्छा. 5, 4, 3, 2, 1, 0. Yay! And there we have it. Okay, but it's not. It's still calculating. What the hell? Ah! Oh, I think the numbers are too damn big. Wait, give me a second. There. Okay. So you see what's happened is for the very first year, if you look at the figures that have come, we have the figures right in. You can see in the very first year, my 100 rupees is not worth 100. It is worth how much?
93.45.
The money which I get 2 years from now, how much is it worth?
7.34.
87.34. In the third year, you see the value keeps reducing because one additional year it has to work hard, and the value which I get 1 year later is obviously much lower than what I can get earlier. So the number keeps reducing. It reduces to such a small value that in a matter of 68 years, 100 rupees that I get 68 years from now is equal to how much today?
1 rupee.
1 rupee. Okay. And you see the number keeps shrinking and shrinking and shrinking and shrinking. And you see it has already gone into like hardly anything. Means if I were to give you 100 rupees, if I tell you, I'll give you 100 rupees 170 years from now, it is like getting nothing. It's like, can you imagine this figure? Like 0.00048 rupees. Will you want such money?
No, sir.
No, right? So now let us do one very funny exercise, okay? Let us start adding up these numbers. So I'm going to add up this one plus, I'll start from the second. So this one is going to be the same. So this is the cumulative. So if I were to wait in the second year, if I were to collect all the money that I get, it will be this plus this amount, okay? Can you see what I'm doing? What I'm doing is, I'm adding all the figures together. Okay, so we have another quick calculation happening. Okay, I'll hit F9. I think Excel is frozen. Oh, I know it's not frozen exactly. Huh. You see, what was the number we had arrived at?
One thousand
When
four hundred twenty-eight point five seven.
you see, we calculated this figure. I did it. I did the math. 100 divided by 0.07. I got 1,428.57. Yes or no?
Yes, sir.
Yes, sir.
Okay. And if I look at the math, can you see this number? I'm getting the exact same number.
Yes, sir.
Can someone say, "Wow, sir, you are the best"? Actually,
Yes, sir.
but it's okay. Yeah, okay, I know. Okay, such a sad crowd, but it's okay. Um,
You are the
can you see? This is
best.
the beauty of. Okay, can you see? This is the beauty of mathematics. Okay, so you can take a complex thing like this. Okay, I'm taking you back to the bond page. Like we went to numbers all the way up to infinity. Okay, and what we noticed is that entire thing can be reduced and brought into such a small form. Like an infinite number can be brought into something so simple. Just do c divided by k, and you get the exact same answer. And we have actually calculated. Can you see what we've done is, and trust me guys, this is the first time I've done this in my life. Okay, I have not done this before, so for me also it was a shock whether it will work or no, and luckily it did work out. So but what we can see right now is the maths is good. It really pans out. You see the figure repeating at the end over here. You reach this figure, and this figure will remain constant. And you know who came up with this formula? Who was the first person to come up with this formula? Guys, any? Isaac Newton. Okay, so Isaac Newton, along with an amazing number of great things that he has done, we all know Isaac Newton for what?
Gravity.
Gravity, right? But gravity, can you imagine, was one of his, in fact, uh, the equations for gravity that he's given are flawed. There are mistakes in that. But he was the one who also taught us the time series, also how you can solve these type of series into very simple things. He also taught us calculus, and that is an even greater, even better explanation of the maths around us. So his contributions to science are immense. And what we know about Newton is hardly just his little thing about gravity and an apple falling on his head and he figuring out things. But the man was a true genius, to come up with so many things. So what we have seen over here is you can reduce a perpetuity to a very single formula. And what is that simple formula? If I want a value, how much should that value be? What should be the formula of the value? Coupon divided
C
by
upon KD.
C upon KD or C upon R. If you write C upon R also, I'll give you the entire marks as well. So this is how you do valuation for a perpetual bond. Very easy.
Yes, sir.
Okay. So now there aren't, besides perpetual bonds, there are other kinds of bonds also. Okay. So, okay, there is a small little example. I want all you guys to calculate this. You can open up your calculators, use the same formula which we just discussed. A bond has a face value of 1,000. Okay, a face value of 1,000 provides a coupon of 8%. What appropriate discount? The appropriate discount rate is 10%. What is the value of the perpetual bond? Okay, the face value is 1,000 and provides a coupon of 8%. So what will be C in this case? What is going to be C? What is your C in this case?
1,000.
No,
T.
F is your F is 1,000. Your C is going to be 8%
80.
into 1,000.
80.
80, yes. So 80 is going to be your coupon rate. All right, C is 80. How much is your R over here?
10%, sir.
So can you calculate the perpetual bond? What is the value?
800.
Yep. Has everyone got this? Means it will be 8% into 1,000, that is
800.
80 rupees, divided by 10%. So 10% is nothing but 0.1. So it is
0.1.
80 divided by 0.1 and you get the answer of 800. Clear?
Yes, sir.
Chalo, wonderful. Has everyone got this? Has everyone got this?
Yes, sir.
Other people? There's only, I think there are only two people in my class today. There
Yes,
is
sir.
Sir.
Ria. Oh, there are
Sir,
three.
got it.
Oh, there are four people in my class.
Yes,
Chalo,
sir.
not bad. Yeah, okay. So we've done the calculation of perpetual bond. Now let us look at another kind of bond. Okay, now this, wait, let me just get this thing damn clear first. Everywhere these stupid eyes are, they have to get the eye replaced by coupon, 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 coupon. Alrighty, okay. So now suppose you have this is not a infinite, it's not a perpetual bond. It is probably a 10-year bond, a 20-year bond, or a 30-year bond. it can be an n number. In mathematics, normally when we want to keep it into a general formula, instead of giving it a particular number, we just say n. So n can be 1 year. If n is for 1 year, n will be equal to 1. If n is for 10 years, n is equal to 2. N is equal to 10. All right.
10.
So suppose we have a condition where this particular bond tells every year, okay, I'm going to give you C. I'm going to give you a C amount of coupon at the end of the year. Also, as a bonus, at the end of n number of years, I'm going to give you a new value, okay, called MV. So at the end of the n number of years, I'm going to give you the maturity value of say 1000 rupees or something. So every year I'll give you around 40 rupees, and at the end of 10 years, I will give you 1000 rupees. What should be the value of this scheme? What should be the value of this scheme? Control Z press. Can someone calculate this? And can you see how the formula looks? Can you see the formula is very similar to what we did last time? The only difference being is at the end of the 10th year, at the end of the n year, you have two things that you're going to get. You're going to get the coupon that you normally get every year, but on the nth year, the last year, you will also get the entire maturity value. Can you see that happening?
Yes, sir.
So can you see, we can then, that entire formula can be reduced into what we have in the next line. You can see in the next line, we have summation t is equal to 1 to n, and you have the formula C divided by, like, you have the present value, plus you have the maturity value of 1 plus r raised to n. Is this easy for everyone, or did someone not understand this?
Can you repeat the question again, sir? Question.
Okay, suppose you have the previous case, okay, like the previous case where there is a perpetual bond. I'm saying it is not for perpetual, it is not for infinity. It is only going to be for n number of years, where n can be 10, n can be 20, n can be 30. Is this part clear to you?
Yes, sir.
Okay, so when it is not infinity, then you cannot use this formula. You cannot use V is equal to C divided by K. You have to use the regular present value cash flow wala formula. All right, use a round formula. But what I tell you is, at the end of the last year, along with the coupon, I will also give you one special bonus, and this bonus I'm going to call it as the maturity value. Then can you see each of these terminology? Let's start from the first terminology. It is C divided by 1 plus R raised to N. That is the present value of the coupon I get on the first year. Correct? Guys, this undoubtedly is a difficult subject, but I am sure you guys can cope up with it, provided you
Sir,
participate.
sir, we have to
Yeah.
consider the question of last that we have solved for this problem.
No. Just use logic for everything. Use logic. If I'm using it, if it is similar, I'm just saying it is similar to the last thing. The last one was perpetual. Perpetual means infinity. Is this perpetual?
No.
Okay. It has how many number of years?
10, 20,
How many
30.
years? Yes. And in mathematics, when we don't know what the year is, when we're writing a formula, what do we write instead of that 10, 20, 30?
N.
We
N.
write n. So this is for an n number of years. Now can you see, every year I'm going to get some coupons? Yes or no?
Yes, sir.
At the end of the first year, how much coupons will I get? How much money will I get? C amount, correct?
Yes, sir. At the end of the maturity, we will get
At the
MB plus 1 plus KD upon it raised to N.
No, we'll go one by one. Let us go one by one. At the end of the first year, okay, I am going to get this bugger, C into 1 plus R raised to 1. Yes or no?
Yes, sir.
At the end of the second year, I'm going to get this guy. Okay, yes or no?
Yes, sir.
Then I add up all those figures, and finally at the end of the last year, I am telling you the figure bottom, you understand, this is how I get present value, correct? Bottom part is clear.
Yes, sir.
In the top part, what I'm doing is I'm writing, I'm getting my coupon. I know I get my coupon at the end of every year, so C is there. Okay, this C is clear to everyone.
Yes, sir.
I'm also saying at the end of that year, of the last year, I will give you bonus. That bonus is called maturity value. I'll give you this also. So can you see this is how the formula will look? Why is the entire class so quiet?
Yes,
What
sir.
happened to Suraj? What happened to Kevin? What happened to Yogini and Aditi?
Yes, sir, getting it.
So if you're getting it, then tell yes instead of wasting my time and I'm repeating the same thing over and over. Got it?
Yes, sir. Yes, sir.
Yes, sir.
Yes.
Okay. Now this, can you see the first part can be reduced and brought as something like this? Summation t is equal to 1 to n c divided by 1 plus r raised to t. Is that clear to everyone? Actually,
Yes.
if you don't get the bottom part, it's okay. If you get the first expression which is given here, if you'll understand this expression, this full thing here, this is more than enough. All right, clear?
Yes,
Yes,
sir.
sir.
Okay. So what we'll do is let us calculate this on Excel. I'm giving all of you a little time. I want you to open your Excel sheets. We have bond C which has a 1,000 rupees face value. Okay, provides 8% coupon. It provides 8% coupon for 30 years. Okay, discount rate is 10%. What is the value of the coupon? Actually, here one line is missing. At the end of 30 years, you get 1,000 rupees. You get the entire 1,000 rupees. What is the value of the coupon? What is the value of the coupon? Can you all calculate this? Can we flower any drop? Anyone has started? Anyone having difficulty?
So can you show on Excel once?
Why? See, it's very simple. Okay, we'll use the same formula which we done last time. Okay, here in this case, how much is my? We have face value also. Face value.
And here
So we
is
have a
30 years.
we have face value of 1,000. We have 10%. We have 30 years. Oh, it's recalculating 1 second. Wait, wait, wait. So I'm going to copy only up to 30. So I'm going to take 30 years. I'll put it in a new file. Um, 8% is my annual compound. So coupon is 8%. When I say coupon is 8%, this is equal to 8% into 1,000. That is 80. Okay. Years are 30, 10%. What is my present value? So you see 80 is here. Rate of interest has to be this guy, 10%. Sorry. Okay. And present value is 1 plus R raised to, that is coupon plus 1 plus R raised to 1. Okay, yep. You should get something like this. Have you all got this?
So wait doing.
Faster, faster. Don't.
Yes, sir, got it.
You all got it? Okay, Yogini, you're done. Apart from you, anybody else? Who else is trying and reached halfway?
Sir, doing.
Doing it? Okay, we'll wait for a little more time. Fairly easy, right? Are you all done? You should get 574 after you solve it. Sorry,
Yes,
754.
yes, sir.
Okay. Anybody else who's got the same answer? People, who else is working?
Completed, sir.
Who is this?
Suraj, sir.
Okay, Suraj, you got the answer? 754?
Yes, sir. Yes, sir.
Wonderful. And anybody else who's still in work in progress, or can I go to the next point problem?
Then, sir.
Done? Wonderful. Okay,
Sir,
all 12 got the
done.
same answer.
Got it.
Right.
Yes, sir.
Chalo, superb. So with this, we've now figured out how to. Acha, wait, one second. Now, what we have done right now is we have only calculated what are the coupon rates you get if you have 80. But you know, on the last year, on the year 30, are we getting only 80 rupees?
Yes, sir.
No,
On the
Not 80.
last
maturity
year,
value
we are
also.
getting maturity value, which is also 1000. So the figure changes. Can you see, normally I would have got only 5 rupees at the end of 30 years. Now I'm getting 61. So the number changes from 754 to 811. So can you see the number has not changed much, hardly 60 rupees change. That is less than the coupon rate after 30 years. Means any money you receive after 30 years is absolutely worthless. Are you getting this point?
Yes.
So this is what happens. This is what happens even when you have LIC policies. So when you have an LIC policy, and you know now when you will you suppose you take an LIC policy which is say 20 years or 30 years old, and they say after you invest 10,000 every month or every year, and at the end of 20 years we are going to give you 10 lakh rupees. You have to understand at the end of 10 years, 10 lakh rupees is not going to be much. It's not going to be worth much. Okay. Now, what does this 811 mean? What is 811? What does the present value mean? What does 811 signify?
The
Guys, go for it.
total amount.
Sorry,
The total amount.
what total amount? See, when I say signify means what is the significance of this a number? What is the significance of the formula of the end result is my question.
Value of the bond today.
Oh, yes, 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 yes. So the value of the scheme which gives me 1000 rupees at the end of 30 years and 80 rupees at the end of every year is only rupees 811. Have you got this? Is only
No.
811. And if you notice, whatever you make in the first 10, like if you multiply the coupon rate by 10, is usually the amount. That's a little complicated thing. I wouldn't want to get you even confused right now. But this is the most important and significant thing about this number. You can take any transaction, and that transaction you can bring it down to present value. Once you have it in present value, you can then look at it, figure it out, uh, see the implication, and then you can make a decision whether I am willing to pay 811 rupees or not. So suppose the government is selling this same bond for 700 rupees. Will you invest in it?
No, sir.
If they are selling, if they tell you I will give you 80 rupees per year for 30 years, and at the end of 30 years I'll give you 1000 rupees, I'm giving this scheme to you for only 700 rupees, will you invest 700 rupees in this? Will you invest 700 rupees in this? Quick. People, are you all sleeping?
No, sir.
No, sir.
So they
No,
give me
sir.
an answer, will you invest it for 700 rupees?
No, sir.
Why? The value of
Yes,
this,
sir.
just now you all
No,
told me
sir.
the value of this is 800
Yes.
rupees. So if it is 800 rupees and the government is foolish enough to sell it to you for 700 rupees, why won't you take it? If the government says give me 900 rupees for this scheme, will you take it?
No, sir.
No, sir.
No.
900? No, hell no, I'm not going to take it at all. But if they give it to me at 700, anything for less than 811 rupees, even if they give it for me at 2 rupees less than 811, I will buy that scheme because I am going to make money out of it. Is this clear?
Yes, sir.
So
Yes,
this
sir.
Yes,
is
sir.
how you analyze any situation. Okay, you bring it down to the present value. See, what we have done over here is we have taken all the money that is coming. What we have done in this Excel sheet is we have taken every money which comes at any point of time and brought it to the 0th year. We have brought it to the present value. Then you add up all of these 0-year amounts and you see what is the value of this particular investment. If it's worth it, yes, good, go ahead. Okay, in a way, we do this even for our own families. When we look at the way human society works is, when you raise a child, the child is not going to give you returns today. Okay, the child will start giving you returns after the age of 24, 22, 23, during that time. And as you grow older, your utility reduces, the child's utility increases. Okay. And the reason why we take care of children today is because we have taken down the present value of all the future returns that we will get from our children. That includes happiness, that includes monetary benefit, that includes security, that includes old age ability, helping ability. All these things we factor in, and then we realize that it is better to have a child and raise a child and invest money today because the returns I'm going to get is much higher. And all that calculation we have done sitting here right now. We have brought all of those benefits into the present value, and then we decide, yes, civilization has decided, yes, it makes sense to have children, and that's why they have children. Okay? Clear to everyone?
Yes, sir.
Yes, sir.
Okay. So, there you have it. So what we have done is we've taken present value of the coupons, present value of the 1000, add them up together, we get 811, and with this we can now move on to the third type of bond. Okay, third type of bond. Now for the third type of bond, in this type there is no coupon at all. So the government says this is like your LIC. They say that I will not pay you anything in between. I am only going to pay you at the end of the term. So when they say I'm going to pay you at the end of the term, can you see that the expression becomes very simple? Can you see the expression becomes very simple? Very well. How to port now?
Yes, sir.
It is just that you take whatever money you're going to get after n number of years, divided by 1 plus r raised to n, and once you solve it, you're going to get your answer. Very simple. Clear?
Yes, sir.
Okay. So if you notice, this this is called as a zero coupon bond. Okay, a zero coupon bond means you get zero coupons. You will only get the maturity value. And a zero coupon bond is a special case. A zero coupon bond is a special case of this kind of a bond. If I make C equal to 0, can you see if I make C equal to 0, 0 divided by anything is what?
0.
0. So you see all my terminologies, that this one, C, then my second term, all the way up to nth term where C is there, that becomes 0. All that I'm left out with is C divided by 1 plus R raised to n. Can you see that? Just a second. Okay, so can you see what has happened? The zero coupon bond valuation is similar to the non-zero coupon bond where C is equal to 0. Very simple case. Clear? Okay,
Yes, sir.
easy up till here.
Yes.
Okay. So now this is one very simple example that has I've been given. This bond has 1,000 rupees face value, 30-year life. The discount rate is 10%. What is the value of the zero coupon bond? Can you calculate this very quickly? Okay, I have a small meeting to attend. So what I will do is I will leave you all with this particular problem. Once you're done with the problem, you guys can sign out, and I will quickly take attendance while you guys are here. Give me a second. So, okay, so till I see you all on Friday, have a great day. Enjoy yourselves. Oh, Friday is the exam, right?
Yes, sir.
Yes,
Yes,
sir.
sir.
Okay, so all the best for your exams, and I shall see you next week.
So please
So you
upload
guys,
the video or recording
okay,
of that last lecture.
okay, fine. I shall do that.
Sir,
Yep,
hello. Sir,
yep.
what about those who students are not having laptop at home? How will they
Those who
calculate? How
then
will
you
they?
come to college. Then you come to
Okay,
college. You sit down in the computer lab and you calculate.
okay,
Okay,
okay, sir.
chalo, wonderful.
Thank you, sir.
Thank you
Thank
so
you, sir.
much.
Thank you, sir.
Thank you, sir.
Thank you. Thank you. Bye bye.